to thank the Main Street Summit team for putting on this inaugural event. I think it makes a lot of sense to bring small business owners and small business investors together to learn from each other. And I'm sure most of you that are out in the audience today are small business owners. I'm sure there's also quite a few of you that are in private equity, that are in venture capital, search funds, people that invest in small businesses that are private. And I'm sure I'm in the minority in this room of investors that invest in small businesses that just happen to be public. And to be honest with you, a lot of the businesses that I invest in look a lot like yours. They just happen to have a ticker symbol that you can buy in your Schwab account. And a lot of people forget that around 65% of all global equities, all public stocks globally, are small microcap companies that most people have never heard of before. And one of the things that I fight almost every day is this misperception about what microcap investing represents. A lot of people like to toss it into the camp of penny stocks, which, is kind of perceived as the slimy, sleazy underbelly of the public markets ecosystem. And yeah, we have our fair share of bad actors, but it's probably just the similar percentage as the amount of bad actors in small businesses that are private. It's probably the same amount of failure, if not less than the amount of failures that happen in the venture capital market. And, I like to try to change that misperception. So I'd like to start off this presentation with just, 4 facts about what microcap investing represents. Number 1, most of the best public markets investors ever started in microcap. Number 2, most of the best performing stocks ever were microcaps. Number 3, 87% of the companies that have outperformed in the public markets over the last 10 years originated out of the microcap and nanocap arena. And last but not least, microcap is the only investment class where the smaller investor has the advantage. And you would think, given these 4 facts, that microcap investing would be making positive headlines almost every day on CNBC, on Wall Street Journal, and that's certainly just not the case. And it's also why there's so much opportunity to be a microcap investor, quite honestly. I'm sure most of you know who this gentleman is. This is Peter Lynch. He's one of the goats of public markets investing. From 1977 to 1990, he rattled off a 29.2% CAGR at his Magellan Fund. And I'm sure most of you in the room here have probably read his book, One Up on Wall Street. And it's actually in that book that Peter Lynch talks about the term multibagger for the very first time. Peter Lynch is actually the father of the term multibagger, and he came up with that term when he was watching a baseball game, and each one of the bases represents bags. And when he talks about a 10-bagger, he's talking about a stock that returns 10 times his original investment. When he's talking about a 20-bagger, he's talking about a stock that returns 20 times his original investment. And I think for a lot of folks, probably a lot of people in this room even, when they think about multi-bagger stocks, they think about these types of companies that are up here on this screen. The Googles, the Microsofts, the Metas. And yes, these are all multi-bagger stocks. In fact, Meta's been about a 7-bagger since IPO. Google's been a 61-bagger since IPO. Netflix has been a 300-bagger. Apple's been a 1,700-bagger since 1981. NVIDIA's been a 2,000-bagger since 1999. Microsoft, a 3,200-bagger. That's a 320,000% return since it IPO'd. And, these companies up on the screen here are also some of the largest companies in the world, the most owned companies in the world. And, I think for a lot of us small business owners, we look at companies like this and we look at their size, their scale, their amount of revenues, their profitability, the reach they have, the amount of employees. And, it's almost like you're looking at a company on another planet. It's like you're looking at a fairy tale or something. And, to be honest, most of us in this room today probably will never run a business that's a 100 million revenue business, let alone a 100 billion revenue business. But, I have some good news for everybody in this room, and that is that most of the multi-baggers that occur in the public marketplace look a lot more like your companies than these companies up on the screen. Last year, Jenga Investment Partners put out a research study, which was really, really great. I mean, you can pull it down. It's free. It's on their website. But they analyzed all global equity outperformers over a 10-year period. I believe it was May 2012 to May of 2022. They looked at all global equities, and they specifically looked at all stocks that went up 1,000% or more during that 10-year period. And what they found was that 87% of all of those companies that went up 1,000% or more during that 10-year period originated out of the nano-cap and micro-cap arena. What was equally interesting was that 82% of those global equity outperformers were profitable. In fact, 91% had a history of profitability. And so if you want to find the next multi-bagger stock, you should find something that's small and profitable. About a month ago, I gave a presentation in Vancouver, and the title of that presentation was Multibagger First Principles. And it was a 27-slide presentation, but this is the most important one that's up here on the screen right now. And I kind of summarized how to find multibaggers, and I drilled it down to one sentence. We want to find undiscovered companies that are growing revenues and earnings and not diluting. And it's oftentimes that last part there that's the hardest. It's this easy and this hard as an investor and also as a business owner to produce something like this. What I'd like to do is kind of run through a few examples of companies that represent what real multi-baggers look like, what a majority of the multi-baggers look like in the public markets ecosystem. And I don't own any of the companies that I'm going to be sharing today, but these are the types of companies that we talk about on MicroCapClub that we try to find early. And I guarantee that most of you have never heard of any of these companies before. So I'm going to look forward to kind of going through each one of these case studies. And when I go through each one of them, I just want you to think about the size and scale and the growth rates of these companies over the time periods that I'm going to be articulating. The first company here is Armanino, and it trades under the symbol AMNF. It trades on the OTC markets in the United States. And Armanino is actually the 65% market share leader in pesto sauce, of all things. And yes, you heard me right, about 65% market share in pesto sauce in the United States. And over the last 14 years, they've grown the market cap from 10 million to 140 million. It's still a microcap company today. Over 14 years, they grew revenues from 21 million to 66 million, grew earnings from 1 million to 7 million. Dilution, 8%. That's the key. Stock price, 30 cents to $4.41. Armanino has been a 14-bagger, 1,400% return over 14 years. And I'm sure for many of you that are out in the audience today, you're looking at what this company did over 14 years from 21 million to 66 million, 1 million to 7 million in earnings. And you're thinking to yourselves, that's not a fairy tale. That's believable. In fact, maybe you did this in your business already, or you think you could. And you're thinking to yourself, I could be the next multi-bagger stock. The next company is Fitlife Brands. It trades under the symbol FTLF. It actually just uplisted to the NASDAQ recently. And what Fitlife Brands does is they own a series of brands in the fitness category. It's mainly supplements, protein shakes, nutraceuticals, things like that. And they distribute those products then to GNC stores and other fitness-related stores and online as well. And to be honest with you, it's a pretty boring business. But over the last 6 years, they've grown the market cap from 3.5 million to 90 million. They grew revenues from 17 million to 29 million. They grew earnings from 500,000 to 6 million and zero dilution. That's the key. The stock price has gone from 70 cents to $20. It's been a 25-bagger over the last 6 years, 2,500% return. And I'm sure there's some of you out in the audience that are looking what this company did over 6 years. 17 million to 29 million, 500,000 in earnings to 6 million. And you're thinking to yourself, I think I could do that. I could be the next multi-bagger stock. The next example is Biosign. And Biosign trades up in the Canadian Venture Exchange under the symbol RX. And what Biosign does is their main product, a bulk of their revenues, is a product called Ferromax that fights iron deficiency. And they distribute that product up into Canada. And to be honest with you, it's a pretty boring business, but the market cap's gone from 700,000 to 90 million. It's still basically a nano cap by most people's standards. The revenues over those 14 years from 1 million to 28 million, earnings from 0 to 6 million, dilution 0. In fact, they buy back stock almost every day. The stock price has gone from 6 cents to $8. This is a 130-bagger in 14 years. There's books written about 100-baggers. Chris Mayer wrote one of the best ones. And it's just funny to think about, a 100-bagger stock, and this is still only a 90 million market cap company. And it's sort of the beauty of microcap investing, really, because you can make a lot of money investing in a very small company that can just become a larger, small company. The last case study that I'm going to be talking about today is Exfil, and this might be a company you've heard of before, but Exfil makes paint protection film. It's basically a clear plastic film that goes over your car to protect it from rock chips. Over the last several years, they've gotten into other things. They've extended the categories into architectural film. They also sell window tint, things of that nature. And over the last 14 years, the market cap's gone from 1 million to 1.4 billion, revenues from 3 million to 350 million, earnings from a slight loss to earning 50 million, 7% dilution. That's the key. Stock price, 4 cents to $50. 1,250 bagger, 125,000% return. And, the funny thing about that is, it took Walmart 40 years to make 125,000% return. It took Monster Energy, I think, 20 years to make that type of return. And, I think it took Apple about 40 years. And, it's crazy to think about that because, Exfil, a company you probably never heard of, did it in 14 years. And it's still a small cap by all standards. And about 2 months ago at our MicroCapClub Summit, I had the luxury of having Ryan Pape come and speak. And I was going to interview him up on stage. And then I thought, instead of that, I'd like to have one of the goats of private investor named Jason Hershman, who's also a member of the club, actually interview him. Jason's probably made more money in Exfil stock than anybody outside of insiders. And it was an amazing conversation. And you can pull up this conversation on YouTube by searching the title above. And one of the questions we actually asked Ryan Pape was it an asset or a liability to be a public company? And there's a lot of words up here on this slide, but I'm going to read them because they're important. In our case, by being a public company, we had this shared purpose. I'd be clear with our team that I'm a large shareholder of the company, but I don't own the company. I could be gone tomorrow and you could still be here. The company can live on forever. I think that helped create that shared purpose. Being a public company was a good thing for the development of our team. A small company can easily be dominated by the owner. You see it all the time. The new marketing plan for next year is sent to the owner to review, but it doesn't get approved. And then you see the owner drive by with a new boat. He bought the boat instead of the new marketing plan. And I think we've all experienced that in some way, shape, or form. This is pretty cool. So this is a couple months ago. Ryan Pape actually sold 1,000 shares at $75 per share. And, Ryan Pape's story is he became CEO of Exfil in February of 2009. He maxed out his personal credit cards for about $25,000 to pay off some company debt. And he started buying some stock as well. And what's cool about this slide is the 1,000 shares he sold at $75 a couple months ago. When you look at the date he acquired it, he basically acquired those 1,000 shares at 4 cents per share. It's basically $40 invested to $75,000. It's pretty incredible. The reason I thought I'd give this presentation today is, as a microcap investor, most of the multibaggers that occur in the public marketplace look a lot like your companies. It's just a boring company that can just keep growing revenues and earnings and not dilute. And I think it's a shame that, especially today versus 20, 30 years ago, that going public as a small company just isn't even on the radar. And I think one of the reasons it's not even thought about is this question that is up on the slide today. What is the additional cost to be a public company? And I think if I would ask everybody in this room, 99.9% of you would answer this question with $2 to $4 to $5 million per year would be the additional cost to be a public company. And I can tell you that because that's what you read in all the articles on the Wall Street Journal. That's what people complain about when you see interviews on why the amount of public equities has been going down lower and lower is because the additional cost to being public. And I can tell you for a fact that that is not true. If it was actually $2 to $4 million to be public, the 65% of global equities that trade today as microcaps would not exist. There's no way they could afford to be public. And the real cost is, well, I actually asked my portfolio of companies that I run, and their businesses are probably the size of yours. I own things in my portfolio that do $5 million in revenue and ones that do $60 million in revenue. And the market caps range from 10 million up to 300 million. And for the companies that are sub 100 million market cap, the actual cost to be public, what they told me, their CFOs, was around $200,000 to $400,000 per year. And I think we can all agree that $200,000 to $400,000 per year is not an insignificant amount of money, but it's sure a lot less than the $2 to $4 million that you've been told. And I think it's a shame because I think there's some companies out there that could benefit by being public, companies where it would help their brand to have a publicly traded equity, where it would help incentivize employees, where you could use your currency for making acquisitions. And quite honestly, the thing that the public markets does better than the private markets is it really gives you a premium if you execute. Consistency. If you could probably be making toothpicks, and if you would just grow revenues 10 or 15% a year, grow earnings at 30% per year, you're probably going to trade at a 20 to 30 PE if you did that 5, 6, 7 years in a row. The market pays up for consistency. And so if you're even a boring business that can just do that, I mean, you're going to get a multiple. You don't have to sell your company to Brent Beshore at 3 times earnings. You're going to get 20 or 30 times earnings in the public markets. And so the reason I wanted to do this presentation is that a lot of you have been misled, or at least you don't have the right information. And probably none of you in this room should be public, but at least it should be part of the conversation, because I truly believe that some of you could be having the next Multibagger stock and you own it today. Thank you.